Welcome to Central Bank Central. I'm Kathleen Hayes. Well, the countdown for many of us has already begun. The Federal Reserve meets just about 4 weeks from now. The question hanging over markets, not just in the US, but around the world, is what is the Federal Reserve going to do next? Are they going to walk through the door that the Fed chair left open after the last meeting when they did cut rates and cut rates again? Or are they going to join what looks like, I don't know if it's a majority, but it's a slim minority of Fed officials who aren't so eager to start moving ahead on rates again so soon? So, perfect time to welcome back to Central Bank Central Rob Kaplan. He is Vice Chair of Goldman Sachs. He served as President and CEO of the Federal Reserve Bank of Dallas. He joins us from Dallas today. And he was the Martin Marshall Professor of Management Practice and Senior Associate Dean at Harvard Business School. So, Rob, where do we start? Well, let's start on the government shutdown because the shutdown looks like it may be, maybe even as soon as the end of the week, be reopening.
Yeah.
So, what do you see there? Who's the winner here? Who is the loser? I mean, and we could talk about the American public.
Yeah.
We could talk about businesses now that have more certainty.
Well, I won't get into the winner and loser or the political part. I'd say the positive of it being resolved is you've heard me say tariffs in the short run are a headwind for growth. Immigration policy, lack of labor force growth, unfilled jobs is a headwind for growth, and the government shutdown has been a headwind for growth. And I would say the combination of all three of those is a lot. I think getting the government shutdown resolved, making sure people get back to work, they get paid again, their incomes get restored. Uh, that will be a positive step in at least taking that headwind for growth off the table. And so, as the Fed balances inflation and employment, I think it was pretty hard with the government shutdown to not be more inclined to worry about the labor market. I think with this resolved, maybe we'll have a more balanced view as we come out of this fog.
Broadly speaking, as an economist, as someone who works in the investment world, is there an impact of political polarization of the seemingly big gap between Republicans and Democrats that is a headwind also kind of for
The,
moving ahead, or are we just so used to it, we just go on?
the uncertainty is a headwind. And I hear that from businesses, big and small, every day. It just I don't know what the policies are going to be. Um, and that could be anywhere from tariff policy to immigration policy to what are are we going to have a continuation of the subsidies for Affordable Care Act, or in fact the premium's going to go up? Those are just all uncertainties at a time when low moderate income workers have already lost 25% plus purchasing power and are struggling to make ends meet.
Well, I'm going to get right to inflation because a pretty important report came out today. The National Federation of Independent Business, the NFIB, does surveys. And in the latest survey, firms list, well, they always list their main complaints, but right now, the largest complaint quality of workers firms get, but the second largest complaint is inflation.
Right.
Is the Fed missing the boat by continuing to lean toward rate cuts at times when businesses are complaining about inflation?
Well, this is not new news to the Fed. And when I talk to businesses, that survey is completely consistent with what I'm hearing. Oh, by the way, cost of capital is not in that survey. I didn't see the survey, but I doubt it's ranked very highly, except in as relates to being able to obtain a mortgage. I don't think cost of capital ranks very high right now. And so I think the Fed's aware inflation's a real problem. Um, and on the tariffs, it depends what business you're in. What I'm hearing, certain businesses tell me there was pre-stocking before the tariffs went into effect. We're now in the destocking phase, and so they expect more impact into next year. There are other businesses that tell me that they've already tried to put some in price. Many have said they've already taken out a margin and will take the next year or two to regain price. Uh, but businesses are struggling to try to figure out how to uh, limit cost increases, and it is bleeding into services. So you've talked to me before, and I've said to you that with the Fed approaching neutral and inflation running this much above target, it would give me a lot of caution in doing further rate cuts. Now, there's one other comment. There are a number of economists who are out there saying, gee, we think the tariffs have already accounted for a half a percentage point of inflation. And gee, with inflation at 2 3/4 to 3, maybe the underlying inflation is not so bad. I've heard that argument. I've listened to it. I'm not sure many businesses would agree that the bulk of the tariff impact is behind us. But this just illustrates there's confusion about this.
Well, as a matter of fact, I was at an event on Friday, the Shut Up and Market Committee held here in New York, and there was a heated little conversation at lunchtime about, hey, wait a minute, how can you say services, the tariffs and the higher prices don't go into services? What if I run a business? What if I'm a doctor? And if I see the prices going up and my workers see their prices going up, that's probably one of the reasons why services prices have continued to rise. And I think for people who don't want to do more right now, particularly on the Federal Reserve, that has a lot to do. This is not about goods prices and tariffs so much or only. That's easy to see. The other part is the difficult part, and that gets you into things like inflation expectations.
Yeah, so this is not so neat and clean as to you raise prices on certain goods or certain inputs, and then it comes out very neatly and cleanly. It tends to bleed, and it affects psychology. And that I do see that most of the places I go. And when I talk to service firms, I talk to quasi-service firms, restaurants, food service companies, they're telling me clearly inflation is bleeding into their business.
Well, and it's interesting too, Rob. I think I asked you this about this the last time we spoke, but uh, in terms of what people see the Fed targeting, uh, very important survey also out recently from the Cleveland Fed, their business expectant services. Their expectation for what the Fed is targeting has been 2% for some time. It's up to 2.5%.
That's a
So,
problem.
yeah, explain to people who don't think about this, but why is that a problem? The Fed, if we go to Fed meetings and conferences, we know what they're saying. What about a regular person? Tell them why the
So,
Fed why this is a
so
big
when
deal.
I sit in meetings with business leaders and people who are in economic circles, uh, there is a little bit more doubt about whether the Fed is targeting 2%. Now, I always pipe up in those meetings and say, nope, they're not giving up on 2%, I assure you. And then the next thing is, but then why are they cutting rates then? And I said, well, they're worried about the job market. And so I think the point of it is when you're balancing weakness in the labor market and above target inflation, Fed has got to be very careful here in that people start to get confused about what the Fed is trying to do. And yes, I think that has seeped out there. There are some people who think that maybe the Fed is not targeting 2%. And I think there are some people, and you've heard them argue that maybe the Fed's already lost credibility. And I think they've got to be, and I'm sure they are, they've got to be mindful of that.
Well, let's look at the labor market then, because that's the justification. That's the motivation for saying, hey, let's be careful. Jobs are weakening, and if they keep weakening, we could get into a recession pretty quickly, et cetera, et cetera. On the other hand, we know that we don't really know what the jobs data is right now for sure. We've got these, markers here and there, but not the ones we're used to. And you can get a lot of data, new pieces of data. ADP is doing a great job with that, but you want to see a trend, right? And that's one of the reasons you need those government numbers, the monthly jobs report, et cetera, to really know what's going on. If you're just seeing little jib jabs here and there, or if you're really seeing a dangerous trend down at a time when we don't even know how many people after deportations, and no more migrants coming in, the labor market looks very different.
So It would not surprise me that when the government numbers finally do come out, they're going to be weak. Uh, However, and here's why. Companies I talk to, again, tariffs are slowing growth. They're coming out of margin, maybe some price, but out of margin, and people are doing belt tightening to get the margin back. Uh, every job that goes unfilled by a undocumented immigrant, and there's millions of them, there's probably a multiplier effect, and that lost income causes a half of another job not to get created. The shutdown is weakened incomes, which should have had a ripple effect negative again on the job market. And so, what I hear from businesses, I haven't talked to a single business that tells me business is falling off a cliff. I don't hear that anywhere. I do hear business is sluggish, uh,
Hmm.
but it's hanging in there, but sluggish. Again, with the government opening again, okay, which there'll be a lag to see the effect of that. And you've got tax incentives coming by beginning of the year. You've got regulatory reform coming. You've got an AI data center power boom that we're in the middle of. Um, I have a funny feeling, my suspicion, my concern would be if I were at the Fed, yes, the numbers have looked weak. Don't debate that. However, they're not falling off a cliff, and you've got some tailwinds coming. One of those tailwinds now I'd add is the government reopening. Was a headwind, will become a tailwind. So this makes the Fed job harder, and I'm afraid the data in the near term may not help them all that much because my concern is the weakness may be backward looking and you might see a firming into 2026. Then let's say you cut rates in December, you're now down to 3.5, 3 3/4. I could see where you might regret having made that move if inflation's running hot into the first quarter and the job market is firming. That's a scenario that I wouldn't rule out. So that's why this is so difficult for the Fed.
But do they have a little bit of history to look back at? Do you remember last year at the end of the year, and then they cut rates, and then before they knew it, inflation, the numbers are going up again? I mean,
Yeah.
is that a possible repeat?
Well, there's a history of December regrets. If you go way back, remember the Fed was in raising cycle, and in December of 2018, they raised in December, and I think within
Yeah.
3 or 4 weeks, they kind of said, "I wish we'd had that one back." I was there at the time. Yes, last December, I think it was a close call, and maybe they would have liked to have taken that one back. And so there's nothing you can do about that, but what I'd want to emphasize, this is a difficult decision. There are going to be a lot of people going into this who are 60/40, 55/45. The reason I mention that, people ask, what's the role of the chair? The chair, if I'm 70/30, 80/20, I'm interested in what the chair thinks, but I'm going to assert my own view regardless. If I'm 55/45,
Mhm.
60/40, then I'm going to be very interested in what the chair thinks, because if I'm in that range, I might be inclined to side with the chair, even if I don't love the decision. The Fed chair will have a lot of sway, as he always does. He'll have more in a period like this going into December.
Do you get any sense? I know the Fed's not political. I know they're independent. I know the independence has been pushed hard by President Trump. But I'm wondering, even so, it seems to me it's a convenient time for the Fed. If you want to show you've got the justification. Yeah, we need to cut rates again at a time when there's a maybe a big question and a risk to what's going to happen in the future if you keep doing that. But it's going to keep you while this transition is made from Jay Powell to the next Fed chair and who
Yeah.
ends up getting picked. That this kind of shows that the regular Fed people should pick one of those people.
This will be a more peaceful decision if they cut rates in December. It'll be a much more controversial if they don't. Having said that, I'm undecided. I'll just tell you, I've thought about what would I do. There are times where I know 4 weeks in advance what I would do. This isn't one of them. This is going to be for me a game time decision, but it is possible that I would go into this meeting and not be willing to cut. Again, is it going to be 80-20, 70-30, or is it 55-40, 60-40? And then again, as I said, I'd emphasize this, people don't realize as much. I think John Williams and Jay are not going to disagree. That we know is a certainty. I don't think it's ever happened where the New York Fed and the chair, I'm serious, in history, go
Yeah.
back and look. I don't think you'll ever find a period where they ever disagreed. And so that debate between the two of them is going to matter a lot because they're not going to disagree. If they want to cut, we're going to cut. If they don't want to cut, I have a feeling we're not going to cut. And they'll sweep up the 55-45, 60-40 types. And so this is a little bit of an unusual situation in that the dynamic, in my opinion, will matter a lot on those two people.
Do you think that they're going to look at the recent, the consumer's been holding up? We've got, it looks like investment numbers are still pretty good. With all that, is that going to be sort of background? Is that
It,
jobs report? If it gets out
it,
in time for the next meeting, is that going to be the one that everybody kind of hangs their
it,
hat on?
it may. So let me put it a different way. I'm a business person. I'm used to making judgments about the future, being a risk manager, and I'm used to the fact that I'm wrong once in a while. We're wrong. Well, I mean, it's just that comes with the territory. The Fed doesn't love to make leaps into the unknown. It really doesn't. I think the October cut, I'm of the view that was a it wasn't a straightforward decision, but I would have gone along with it, and I think I could sleep well at night. This one in December, I think, is really harder because you've got weakness right now. Data's not going to. I don't think the data is going to dispel that there isn't weakness right now. There's weakness. So then the question is it temporary? Are we about to head into a firming? And that requires a leap.
Hmm.
For those who want to cut, they're making the judgment, oh, gee, inflation's going to improve it into next year. That requires a leap. I really hate to make that leap on inflation. I think the truth is what I learned in my years at the Fed and since, I think there's a much better grip on analyzing labor. Inflation is a much tougher thing to predict. It's just harder. And it's much harder to understand inflation. It's a much fuzzier thing to try to get your arms around. And so that also makes this harder.
AI, what are you seeing there, Rob? Certainly, big companies, pouring a lot of money in. Certainly, does how we don't know how much that has to do just with riding the wave. There was just a big sale, of Nvidia by a major Japanese firm. So, what do you see there when it comes down to the
Yeah.
economy and what it's really doing for the economy and going to do for the economy and workers, particularly kids coming out of college, and what it's
Yeah.
not going to do, what it's going, how it
So
might hurt some of them?
so when talking about AI, let's separate the ecosystem. And okay, there's the chips companies, GPUs. There's the infrastructure. That's data centers and others. There's power. Okay, that is going full bore. Then you've got applications which are going to happen downstream, industry by industry. And I would argue that is in the early innings. Okay. Most industries I talk to are trying out use cases right now and have not determined which use cases will work and which haven't. They will figure it out over the next few years. The job market impact, the infrastructure part is stimulative. It's capex. It needs construction workers. It's stimulative. The downstream part is the part that gobbles up workers. Use cases that work means we can substitute technology capex for workers. And and I think we've still got to go through that learning. And that's why there's a lot of uncertainty still. My guess will be 5, 10 years from now, when we look back, it will have been transformative downstream. Certain use cases will be shocked, don't work at all. Certain use cases are work better than we thought, and there'll be a whole range of new jobs we're not even thinking about right now that will get created. But that's where a lot of the uncertainty comes from
Is there anything that,
downstream.
oh, but down in the future, but in the meantime, do you think there are, it seems to be one of the reasons why younger people college age kids are so interested in AI is because they're wondering what it's going to mean for them getting a job and what they should be
It's
studying now to get the
it,
job, because they thought if they were computer programmers, right, and
yeah.
doing all that, they'd be fine.
So I was just at Harvard last week. I'm on campuses so my strong advice, it's going to affect all of us. It's going to affect me. It's going to affect all of us. It's going to affect the job a new hire does. A lot of the analytical work that new hires used to do, AI will substitute for it. That doesn't mean there won't be critical roles for junior people, but reading, writing, communicating, interpersonal skills, judgment, uh, those I would argue are going to be as important as ever. AI is not going to replace judgment. It's not going to replace building a relationship. And I would say, so for those who are very heavy quantitative and are on their device all the time and aren't as good at face-to-face relationships and communication, I'm urging students, you're going to have to work on those things. You're going to have to work on your other skills because if quant, you can automate, and analytical skills are still important, but it will be the review and the judgment part. And so there'll be plenty of jobs again, but I'd say students should be careful about not being too technical or narrow, and
Okay.
the broader reading, the basics, reading, writing, analytical judgment skills, other skills are going to be more important. I don't think that's a bad thing. I think to be a junior person may be more fun than it was 25 years ago because I never enjoyed all the grunt work anyhow. So but you're going to have to still understand it. But judgment's not getting disrupted out of existence.
Okay.
Relationships won't either.
So I want to ask you a couple kind of more technical Fed questions, and one of them, I'm sure that you discussed at the Dallas Fed banking conference recently, where Lori Logan, your successor, is arguing, as some other people have, but pretty clearly, she's been kind of a thought leader in these areas, that the federal funds rate. Listeners, if you don't know what that is, when we talk about the Fed's key rate, that is very short term, kind of overnight. That's what they move. It doesn't work anymore. It's antiquated, and we need a replacement for that. Do you agree? Is it a big deal, or is it just something like housekeeping?
So we've been talking about this for at least 5 or 6 years. And so just so for the audience, Fed funds rate is not a traded rate. It's a stated rate. Then the SOFR, the overnight financing rate, secured financing rate, is usually in the neighborhood of the midpoint of the Fed funds range. There's a thing called the tri-party repo rate, secured rate, which is narrower collateral. Same thing in the middle of the Fed funds rate. This is a technical issue. The thing I would say is it's going to get debated out. I would guess it won't get changed until you have a new chairman. What I would want to see come with it is a review of the whole plumbing system.
Hmm.
So right now, I would argue you've got overnight rates, you've got reverse repo, you've got repo, reverse repo, to the point where most business people and even people around the Fed need to have it explained to them again every few months because it's so complicated.
Makes me feel better.
Well, and again, if you're in an abundant reserves regime, some of these things don't matter. If you've got just more ample reserves, and you're seeing this right now, frictions in overnight, the plumbing, this is why the Fed struggles to predict how far they can do the balance sheet runoff because they feel their way because nobody quite understands how this plumbing works. So I would say all this is going to get wrapped up into a broader discussion. It can wait for a new Fed chair.
Hmm.
Uh, but they'll either pick SOFR or a tri-party rate or stick with the Fed funds rate, and a lot of it will depend. Do you want ample reserves, abundant reserves? How tight are you going to run reserves, and are you going to make some changes to the plumbing? This all fits together, and I don't know the answers yet, but I'm glad they're
Well,
discussing it.
Yeah, well, and it's certainly, and I think it is becoming a bigger topic, and you see it at more and more conferences. So clearly, it's a big deal.
I think the plumbing is a bigger issue than the selection of rate at the
Yes,
moment.
yes, exactly. Well, plumbers make a lot of money, you know.
Ha, right.
They're scarce. But before I let you go, I want to talk about fiscal policy. Let's go back to about 2021,
Yeah,
2020, when you were looking very carefully at this. You know, a lot of us
yeah,
didn't, people about COVID and the inflation didn't realize how important it was. There was so much fiscal stimulus. Where
that's
are
right.
we now?
So, as you said, remember we had 6 trillion of extraordinary programs authorized. CARES during 2020, that was 2 trillion. American Rescue Act, another 2 trillion. Inflation Reduction Act, trillion. Infrastructure Act, bipartisan, trillion. So that's 6 trillion in what was at the time a $27 trillion economy, let's say, on average, we're 30 today. Yeah, that stimulus is stimulative as could be. And I argued with you the Fed wasn't sufficiently taking into account how big the stimulus was, and it needed to be backing off monetary stimulation sooner. And it was late in recognizing it. Okay, fair enough. So now what's happening? The Trump administration is trying to roll back what's left of the authorized money and not spending it. They're trying to substitute in tax incentives. They've done something that should be a little bit of a headwind. They would be very upset to hear this, but some would argue, let's put it this way, that the tariffs are a form of tax increase, which were intended to offset some of the deficit. And so the long and short of it, we just ran a $1.8 trillion deficit. Tariffs knocked that down a bit. Um, if the tariff regime stays in place, if they keep trying to control fiscal spending, and if growth rebounds some, I would think those $2 trillion deficits may be somewhat lower. If we grow nominally more than 4.25%, based on the scoring of the recent legislation, I think you'll see that we'll start to deleverage some. But that's the question. If growth is sluggish and we don't control spending, these deficits are going to get worse. If growth is stronger, which it may well be, I think labor force growth would help with that, by the way. Some more clarification, rationalization of the tariffs. Well, if growth is stronger and they keep controlling fiscal spending, I think you might see deficits actually improve, but we're going to have to see which way this goes. That's why the government standoff was not the be all end all, but it was about, for one side, um, holding the line in their minds on spending. The counter is you're holding the line on spending, but for those who most need the assistance. But that's the reason for that fight. They're determined on one side and the administration, I think, to control spending, get more growth, and start to deleverage, and then be able to better sell the 10-year and longer treasury, which we're struggling with right now.
Okay. Well, Rob, thank you so very much for taking the time.
Good to
So great
talk to
to
you,
see
Kathleen.
you. And I'll be thinking of you. I guess a lot of us will be thinking of you and everybody, former and current Fed officials, just about a month from now when that next
All right.
meeting comes. Okay. Rob
Good to
Kaplan, of
talk to you.
course, Vice Chair of Goldman Sachs and former President of the Federal Reserve Bank of Dallas. Nice talking to you too, Rob. I'm
Nice to talk
Kathleen
to you,
Hayes,
Kathleen.
and this is Central Bank Central.